Make sure this is working. What's up? What's up, Bomgia? I read your DM this morning, by the way. I didn't DM you back. But I read it and I appreciate it. So when you have time, we'll go through it, and I know where you're coming from. We've all been there. The good thing is, obviously, we're adults. Faced with that realization, you're like, shit, I gotta change something. If you didn't actually like look at that data and you didn't realize like what was going on, you almost make excuses for yourself a little bit. But when it's like a blunt reality, you start to like make a decision like, shit, I gotta change something. So I'm there with you, man. Just gonna wait for a few minutes, wait for people to get on. If you're watching the stream right now, if you're watching it live, we're waiting. If you're watching a recording, probably skip through this part. I started a little early just to make sure everything was good. Got some sexy lo-fi in the background. Hopefully this doesn't get hit with a copyright because I don't want this video to go down. Hopefully it continues to provide value for people for a while. I think the agenda today, we're just going to go through some TTI material. We're going to review some trades. We're going to use Koifin and kind of run through a pseudo strategy session, a real short one. We're not going to dive too deep. But there's some new guys in here. This is a free mentorship session. I want to be able to
it's been hard trying to find what I want to do, how I want to do it, try to find a consistency. And it's this right now, this time is not really a great time. There's no real, like, we're full on full. So it's hard.
It is definitely not the easiest time right now to be trying to figure shit out. That is for sure. I totally get where you're coming from. The main thing to focus on is, in this type of environment, in my mind, is position sizing. If there's like one variable within your trading process that you can for sure focus on right now, it's position size. And that's, you're not out to turn your account into $1 billion account overnight, but you are trying to stay in the game and take those base hits as they come in and grow that account. So by minimizing that overall risk per position, if you're not certain about what's going on, if the market's kind of flip-flopping back and forth and you're just having a hard time reading it, using the smallest possible position size that you're comfortable with is probably the best way to go until you find consistency. That's what they would do to you on a prop desk as well, right? If you're having a hard time, they don't kick you out, but they do size you down. And that does two things. One, you don't blow an account, and two, it's a little easier to maneuver through the market when there's not a bunch of money on the line. That's why paper trading is so much easier than real life, right? Because the emotions that are involved aren't there in paper trading. So if you position size down and you're used to trading decent sized position, you can kind of let things go a little bit more and let the system work itself out, and you'll hopefully gain some of that consistency back. Also, I appreciate you being on time.
Yeah, at a job site today, so it's easier to get on.
Were you working this morning?
Yeah, it's 9 a.m. over here, so just starting today.
Well, I appreciate that. So I think what we're going to do, since I haven't posted on social media it's been like a month or 2 months, and I just started posting again to try to get this out there, and obviously the algorithm doesn't like me right now because I'm not posting. So I'm not really surprised that there's not a whole lot of people in here. So I guess what we can do is kind of focus on a really quick strategy session where we go through Koifin, but not super in depth. We go through the scanning process, but not super in depth. And then we'll spend maybe 20 minutes going over 2 of the most recent trades we took. We're going to use First Solar since that's a popular one, and that exemplifies the COD setup. And then we can use, I was trying to think of a BRB setup that has worked in our favor. ON. We'll use ON. Yeah, okay. So we'll use ON as the BRB. We'll use First Solar as the COD. And then at the end, any questions regarding technical analysis we can go through. But we'll wait for another 5 minutes. If no one hops on, it's just me and you. Maybe we could run a one-on-one right now, just me and you, and I'll stop the stream.
Sounds good.
Just ate lunch, by the way. Had chicken hearts. Feel like you'd appreciate that. There's a thing down here. I don't know if it's popular in Central America, but it's called galinha, which is like an old chicken, and so they purposefully like wait for the chicken to age, and then they kill it and eat it. And the meat, it's different. And so even though it's chicken, it's like 2 completely different types of chicken. It's like all dark meat. The texture's a little bit more gritty, and the taste is definitely, it doesn't taste like normal chicken. It's not bad. I think I prefer white meat, normal chicken, but they love it down here, man. So I opted just to eat the chicken hearts. Heck yeah, Dave. Dave Portnoy is hilarious on Twitter. Okay. We're just going to run through some stuff really quick, and then people can watch the replay. I don't want to sit here for too long. Okay. So let's run through... First things first, for anybody watching this, we... supposed to be a free mentorship session, and so what we're going to do is we're going to go through a really quick strategy session with Sal. He's at work right now, so he's probably not going to talk too much, but we're going to run through something that we normally do on Sundays, Mondays, and Wednesdays as a group. Get a huge group of us, 20, 30 guys, and we go through the entire market, and we kind of figure out where in the market do we want to be long, where in the market do we want to be short, where in the market do we want to avoid. Everything starts with CoiFin. This is the program that we use. I'm going to turn down the music really quick, just in case it's a little too loud. Okay, so CoiFin, it's free. You can create an account. I don't get paid any money for telling you guys to do this, by the way, but this is a fantastic program right now. that will allow you to find sector, industry analysis very easily. And other programs don't readily have that available. So that's actually where we're going to start, is the U.S. sector and U.S. industry portion. We're going to start with year to date. If you've been trading for a while, you probably have heard the term multi-time frame analysis, and it's something that we do all the time in here. We are swing traders. Generally speaking, our trades last from anywhere between 5 days and 5 weeks. That's kind of the window that we go for. Anything past 5 weeks, we don't really want to go for, because we have this sweet spot of 45 to about 80 days out in expiration in regards to options. And if you start going out past 5 weeks, theta and trends start to break down, because we're not in a bull market right now. And so we kind of found that sweet spot between 5 days and 5 weeks. So we start with year to date to get a macro view. What are we doing here? Because 5 weeks is obviously more than a month. Year to date chart matters to us. We want essentially all of the data from this year to tell us where in the market is money flowing in at this point, where is money flowing out at this point, because we have this base understanding that sector strength and industry strength are huge in finding potentially profitable trades. So statistically speaking, sector and industry inflows will increase the probabilities of those individual stocks within those sectors and industries to pop. So if we can positively identify sectors and industries that are showing relative strength, we can then go and find the companies within those sectors and industries that are showing the breakouts, right? We can niche down and then buy those, and those statistically have the highest odds of continuing through those breakouts. That's what we try to do every single day inside of the trading initiative, and that's where we're going to start. So year to date, we're looking at U.S. sectors. A few things I want to point out. XLU, this is your utilities sector. We're at all-time highs within XLU, which is surprising. You want to point this out. This is generally more of a defensive sector, but due to the Biden administration coming out and talking about the solar initiatives and the clean energy initiatives, a lot of XLU has cross exposure in towards that clean energy, that solar, those industries. And so XLU, a lot of the names are popping up into all-time highs. And there are potential trades within XLU. Like I said, usually it's a defensive sector. Traders don't really like to buy utilities-based names because they just move too slow. You need volatility even as a swing trader. Obviously, if it doesn't move, you're not going to be able to buy low and sell high. Or if you're shorting, sell high and buy low. If it doesn't move, there's no opportunity. So generally speaking, we try to avoid XLU, but as of late, XLU has come up on our 50-day scans over and over and over. So it is important to throw that caveat that, hey, even though this is a defensive sector, there could be potential plays in here. We can see the uptrend starting from about the middle of June. It's been now 2 months straight of XLU creating higher highs. So that's a part of the that's part of the market, this sector that we want to scan through and find potential breakouts, correct? XLE was a name that we had been long essentially since December of last year. As you can see, this was the top performing sector. It still is, but it was the top performing sector by leaps and bounds. As a matter of fact, it was one of the only sectors that was positive on the year back in June. We have drawn down. There's a lot of stuff going on behind the scenes. As a technical trader, it's not up for you to go and figure that shit out. Don't worry about it. As a technical trader, you are focused on one thing and one thing only, and that's price. Price is the only thing that pays to you as a technical trader, all right? So we were in XLE up until about the 3rd or 4th week of May, and then we got bopped out of our positions. This has been one of the most profitable sectors that we have traded in the last 2 years because we were able to catch a lot of those energy plays in December and January prior to whatever caused oil to pop. We saw crude oil popping way before Russia invaded Ukraine. That's what your job is as a technical trader. We're able to ride through and roll out these positions through a majority of this move and then get bopped out eventually for huge profits. Now, we stayed away from XLE. We weren't looking to short this because we don't really know, right? There wasn't necessarily breaking any levels that gave us clean entries, and there is some fundamental stuff going around. We call it headline risk, right? We don't want to necessarily trade through headline risk, but here we're starting to see a rounded bottom with a series of higher highs, and we've been talking about for the last week. We think it's time to potentially start looking at going long energy again, even as crude oil is dropping in price. As we'll see later on in the session, we can look at oil. You can see that the price of oil is creating lower lows, whereas XLE is starting to create higher highs. That's a positive divergence for energy. And generally speaking, energy will front run U.S. oil. There's only one reason why people and sophisticated investors with big money are buying energy, and that's because they expect those companies to be worth more in the future. And there is a direct correlation between oil and energy. So if you're a technical trader and you understand those correlations, I think it's reasonable to assume that I think the market thinks U.S. oil is going to go back up. So we're looking at this XLE. We do want to start getting along XLE. We will scan through this shortly. XLU and every other area in the market on the year-to-date chart has not really done a whole lot. We've stayed out of a lot of this stuff. We have not actively shorted a whole lot throughout the entire year. We've taken our shots. We've shorted opportunistically, but we are not a short biased group. We're not trying to time tops. We will find sustained downtrends and sell into rips and try to capture some base level breaks to the downside. We've done that plenty of times, but realistically, I should say, a majority of the time traders are going to be more profitable long. It's just the way that we're wired. And so even though we may not have participated as much to the short side, we did stay out of the bullshit. So we did not actively go and lose a bunch of money trying to go long these dips. And that matters in the long run because there are a lot of guys that are now broke halfway through 2022. Thankfully for us, nobody in our group is. We did start to go long growth names in June. Posted about it on Twitter and YouTube and TikTok and Instagram and everywhere else. We saw positive movement off of XLY and XLK. Not so much XLC, but we found some rounded bottom areas, and we are still technically long some growth names. So I want to focus on this really quick. On the year-to-date chart, as I hover over the lines, you can see that rounded bottom sort of forming in the middle of, at the beginning of June, I should say, and then we start creating a series of higher highs going into the end of June, into the beginning of July within this consumer discretionary sector. We were out there buying retail. We were out there buying some of the auto names, right? So we don't do stuff for no reason. We always have a reason why. And this U.S. sectors year-to-date tab that you're looking at here is a great way to find where money is starting to flow. XLK, you can see the same sort of price pattern. We rounded out a bottom in the middle of June. We started hitting higher highs. That's why we went long software-related names. XLK is your tech sector. And the rest of this stuff we've stayed away from. There's a few of us that might be still long some healthcare-related names. We did grab biotech at the very, very beginning of this run. Most of us got out of that biotech within, I think, 7 to 10 days after buying it. Good name. We got our profits, and then we stayed out of it. XBI, which is the ticker that we originally looked at for biotech, has continued to run, but for the majority of us in TTI, we have not been able to hold that position simply because XLV is consolidating horizontally, right? We're not really making a whole lot of noise here, whereas other areas of the markets are. And so we took the profits from our biotech trade and we rolled them into some other growth areas, namely software related names and consumer discretionary, right? So those are the areas of the market that we want to focus on: consumer discretionary, technology, which is your XLK. We want to stay away from the majority of this middle stuff. We want to start looking at XLE because you can see the strong uptrend here, and then potentially some XLU. Normally what we would do, but for sake of time, we would niche down, right? We talked about multi-time frame analysis. We'd look at quarter to date because this matters for 5-week trades, right? We're looking at, okay, what are the trends of the individual sectors here? XLY, consistent uptrends. We've had a drawdown over the last 3 or 4 trading sessions. Is this the end? Well, we see that we haven't started breaking levels and hit lower lows yet, so we haven't bopped out of our positions. XLK is the same thing. Another 1 or 2 sessions to the downside, and this upwards trend that we've been in since the beginning of July, so realistically 6 or 7 weeks now, would probably be over. But as of right now, it's not. XLE is still hitting higher highs. This is why we're talking about it right now. This is why we started talking about it at the beginning of last week. And as you can see, other areas of the market have been underperforming quarter to date, namely, right, healthcare. I said that we did not continue to hold our biotech names and we rolled them into areas of the market that were performing better. Here's your proof. XLV is only up 3.65 quarter to date, whereas tech is up 16.51 and has drawn down from 19.23. So understanding where money is flowing is crucial for TTI traders. We take advantage of this because we know if we can catch where money is flowing in, probability of bigger trades presents itself. Normally we would go into a shorter time frame as well, but for the sake of time, we're going to flip over to the U.S. industries. Something I want you to focus on is that sectors are all encompassing. There's only a certain number of sectors, right? You can see here, Koifin uses the XL tickers. There's lots of different sector tickers, but realistically, there's only 10 or 11 different sectors of the market. You have consumer discretionary, which is you have a bunch of money. What are you going to go buy? You're going to go buy nice cars, Tesla. You're going to go spend shit on Amazon, right? That's your XLY stuff. It's where do you go when you have an excess of cash and you want to spend it. Then you have consumer staples, which are things that, hey, you're going to buy from even if you don't have a lot of money. Think Walmart, think Kroger, think Pepsi, stuff like that. Energy, obviously, financials, banks, stuff like that, insurance, healthcare. We know what healthcare is. Healthcare insurance, medical and nursing staffing, all of that stuff is in here. Industrials is kind of a catch, right? It's anything the market doesn't really know. Throw it in industrials. It's aerospace and defense. It's logistics. It's legitimately industrials, right? It's like Caterpillar and Honeywell. Bunch of different stuff in industrials. Materials, mainly commodities based. Real estate is REITs, etc. Technology, we have software, we have internet. Communications, we have stuff like social media, we have stuff like Google, then we have utilities. So realistically, this is the max number of sectors. But industries, what they try to do is they try to niche down the sectors, right? So for example, let's take energy because that's what we're going to be looking at right now. This is a full sector. Anything that has to do with energy is going to be an XLE. But how many industries are within XLE? Think about how many different areas of energy there could possibly be. There could be, for example, excuse me, how about the tankers that are moving energy related or oil stuff? Let's say we're drilling for oil and we're refining it and we got to ship it to Europe. Those tankers, for example, STNG, those are going to fall under a few different industries. And one of those industries is going to have exposure into XLE. So that's a marine shipping name, STNG, that does have exposure into the energy market. Then you have things like oil and gas exploration and production. The actual companies that go out there and find the oil and then start ripping it from the ground, right? Those are your XOP related names. Then you got names, for example, AMLP. This is a subsection of the sector. This is a little bit harder to trade. But it's essentially companies that own derivatives of oil stuff, right? So they've broken those off as well. You have those in AMLP. You have oil services. Think names like SLB, things that aren't necessarily drilling for oil, but provide some other aspect within the energy sector. So what industries are trying to do is niche down within the different sectors. So with TTI, we find where is money flowing at the sector level, and then within the sector, which industry is getting all of the money. And as you're about to find out, it's XOP. Look, it's up 50.24% year to date, and it's down from a peak of 77.12. Now, I want to point something out. If you are not buying the strongest name, you are missing out. And that's hard to do all the time. So I don't want to sit here and say, hey, you only made 10%, we made 50. Like, listen, a winning trade is a winning trade. As long as you're beating SPY, good job. But what we try to focus on is buying the strongest stuff. So, for example, let's say you've been long energy all year. Obviously, great trade. Congratulations. But let's say you've been namely in oil services, your OIH-related industry. You're up 28.57% this year. SPY is down 10.46. So congratulations. You're beating SPY. You're beating the benchmark. That's what every trader is trying to do. But what happens if your buddy goes, well, that's nice. You're in OIH. I'm in XOP. He's up 50.24%. Who out-traded who? Who had the most alpha? It's your buddy that bought XOP. And so what we try to focus on in here is, yes, we understand from a sector viewpoint, energy is leading at 46.16. But what part of energy is leading the most? XOP, right? So generally speaking, these industries are going to be smaller in market cap. They're going to focus more on certain market caps, and they're going to be more volatile. So for example, let's say you bought OIH, which is up 28.57. When XLE is up 46.16, you would have been a better trader, if you will. The trade would have been better if you just went and bought the entire sector as opposed to trying to get cute with the industries. So this is why we do this. We try to niche down and figure out where in the sector is having the biggest impact, right? And in this case, it's XOP. So year to date, XOP is up, AMLP is up, OIH are up, all three energy related industries. Makes sense. TAN, this is your solar related stuff. This was actually trending down underneath zero almost the entire year until the recent Biden administration stuff came out. We will go through a TAN trade that we actually took. I'm not in it, but the guys in the group are. And it was a very heads up play. But this is how fast things can change. All of a sudden, TAN's up 10.2%, and in the fifth place year to date. And 2 months ago, this was down in like the middle of the pack, maybe even sub 50% performance wise. So things can change very, very fast. So you have solar, you have PBW. Look at PBW, huge move off of the same Biden administration headline, and yet it's still down negative 17.96. It was at one point down 35.79. So this has recovered almost 50% of what it was at one point down, which is crazy to think about, but that does offer us an opportunity to trade if you catch it early enough. Then you have some real stinkers. You have names like internet-related names. FDN, look, this is the worst performing industry of the year. Think of what type of names could potentially be in FDN. What are internet-related names? I'll show you really quick. You can come down here on the paid version of Koyfin, type in FDN, go to holdings, and you can look. Let's go year-to-date returns. Let's look at the best first. Box, BOX, 15.85% up. You have Citrix Systems. Twitter is up 1.78 on the year. Even through all the controversy, Twitter's up. And then you got some really bad names. Look at the return. Snapchat, down 75.42. Fastly, you've been trading for 2 years. You remember the meme run in Fastly, down 70.86. Opendoor, Teladoc, Netflix, Coupa, Okta, all of these names down huge. This is the worst performing industry on the year. So if you're a growth trader, quote unquote growth trader, you know most of these names, and you probably tried to trade some of these names this year. Maybe you're trying to buy the dip, or you know some friends that have bought the dip. They probably got fucking burned bad. This was the worst performing and has been the worst performing industry on the year. And this is why we were able to avoid buying these dips. We don't buy stuff in downtrends like this. We would prefer to buy things going up and to the right. So as you can see with IGV, etc., we saw a resurgence in XLK. You can see within the industries which areas of XLK were popping up as well. IGV, you can see the rounded bottom in the middle of June through July. And then you see a series of higher highs. That's why we were going long software-related names. XRT, you see the same thing. This is your retail industry. This is an industry within XLY, your consumer discretionary. So I just told you guys, consumer discretionary is up the most this quarter. We caught that. What's up the most within consumer discretionary? It's going to be your XRT related stuff, right? So this is how we break down sector and industry strength and then go and filter through those to find the best opportunities in the market to actually go and buy. We use this security analysis portion to deep dive ETFs. I just did it with FDN, but for the sake of this, I want you to look at XOP because this is the top performing industry of the year. So if we typed XOP in security analysis, we went to holdings, and we returned from year to date, filter through returns, PBF, number one. So I want you to look at the chart really quick in TradingView. What we do is we go through tickers like this and we go, is there an opportunity to buy this name? Does this look like any sort of play that we have within TTI? And we'll go through those plays in a second. But no, we realistically probably would not want to be buying PBF until we're above 44, which is a previous a local high at the very least, going back to 2019. We would probably not want to buy PBF until we're up and over 44 because we know there's going to be overhead resistance from everybody that was buying up here. A lot of guys probably held through this drawdown, which is pretty nasty, 44%. And these are the guys that are saying, I swear to God, I just want to get out of break even. I'll never make this bad trade again. We want to be able to buy when they're selling up at 44. We just go down the list. OXY. If you were trading yesterday, you saw OXY. This is the Warren Buffett name. Do we want to be buying OXY here? We had a buy trigger at $70. I think one of the traders in TTI got long. For most of us, we're looking for a slight pullback on Monday within OXY to start getting long. But this is a great name to get long energy. You can see there's a very obvious level at the $70 area to get long. So we know where we can risk on and risk off. RSI above the 50, which is one of the parameters. You see a massive 4.13 ADR in a large cap energy related name. This means that on any given day, on average, from peak to trough, this thing moves 4.13%. That is a lot. When you compare it to something like XOM at only 2.76%, on average, this thing moves 2.76% per day, whereas OXY right now is moving 4.13. If you think about it from a volatility standpoint, OXY is going to give you a better potential trade because, listen, you cannot make money if you buy something and it fucking stays the same. right? It just doesn't work that way. There has to have some volatility. Right now, OXY has more volatility than XOM. We can look at names like AR. I'm going to tell you a lot of the names within XOP are going to have the same sort of charts because they are very highly correlated. You can see we had a run up. You see the drawdown, the steep drawdown that we've been able to successfully avoid buying. And here we are looking to potentially buy these breakouts once again. I'm going to give you a name right now that I know looks fantastic, and we can run through it. So if we know we potentially want to be starting to get long energy, right? We saw the XLE sector creating higher highs on the year to date. We looked at it on the quarter to date. We confirmed it, right? Then we went into U.S. industries and we saw XOP with the same sort of movement. Listen, XOP is starting to create higher highs again. Matter of fact, OIHs as well, and AMLP. It's about time to start looking at going long energy again, regardless of what we think. If we look at U.S. oil really quick, I told you we'd look at this. U.S. oil is in a downtrend. We are consistently hitting lower lows, and we're down 27.76 or something percent. Generally speaking, XLE and U.S. oil are correlated heavily. But right now, there's a divergence. Why is XLE rebounding and heading up when U.S. oil is not? Which one is lying? And we think right now it's oil. We think that at some point oil is going to find a floor and reverse. And why do we think that? We think that because there are people in the market with better information than us, because they are richer than us. They have access to everybody in the world, including, the royal families in Saudi Arabia. There are people right now buying energy-related stocks, and there's only one reason why sophisticated investors buy anything. That's because they expect over time for it to go up. So if XLE right now is going up and oil is not, we expect oil to eventually find a floor relatively soon, by the way, and start heading back up. And when oil does start heading back up, that gives juice to XLE because we know there's a positive correlation. So what we do, we go through our scanner. And this is how we're going to find that name I just told you about. And I'm going to start over. We're going to reset this. So once we know within TTI where we want to start looking for longs or shorts, given that, but right now it's longs. That's the first portion of our system, right? It's the TTI analysis, the market analysis portion where we use Koyfin deep dive sectors. We go through a lot more than just sectors and industries, by the way. We use factor analysis. I'm not going to do it right now, but we find where within the market is actually showing the greatest strength and weaknesses through market caps. Right, so we're breaking down small cap growth, mid cap growth, large cap growth. I mean, we get really detailed, and it gives us a high level of precision when it comes to finding trades. All right, so once we know where we are, we can use any scanner you want. We use FinViz just because it's free and easy. You can use any scanner you want. We have a very basic scan we like to run at the beginning, and it's a 50-day high scan. So what we're going to do is we're going to go to the 50-day highs, and we're going to hit new high. Right now, just prefacing this scanner, by the way, every scanner more or less works the same, but a scanner is only worth what you know to scan for, right? So you could give me any scanner and I could find any part of the market I want because I know how to build the filter set. And that's what the most important part is. A lot of the questions I get from beginning traders are, listen, I don't know how to use a scanner. What do I do? And I go, well, what are you trying to scan for? And they don't even know. That's the first part. You have to know what you're looking for. All right. So 50-day highs is a great place to start to find breakouts. It's a great place to start to find where's the relative strength in the market, things like this. So it's a fantastic place as a base level. Let's just start right there. What is going up if we are looking to go long? 50-day highs. Next thing we use, average volume over 1 million. Why do we do this? Very simple. Let's get rid of the shit tickers. Let's get rid of the stuff that is thinly traded. If you're an equities trader, you probably don't want to trade something where you're going to get stuck. If you're an options trader, more or less, you're probably not going to have volume on the options chain to even do anything if it's less than 1 million. So let's just get rid of all of the crap that has low probability of us being able to actually even trade it. So over 1 million average volume. Drinking my coffee, I apologize. Optionable and shortable. Listen, if you're an options trader, that has to be on. It has to have an options chain. And why not allow shortable names? We know what short squeezes are. You've been trading long enough. You've seen a few of them over the last 2 years. Hell yeah. If you're looking to go long, shortable names are a great place to start, right? So if you find one of these names and it just happens to get squeezed, congratulations. That's just more juice for your long. So let's throw that optional and shortable. And what we've been doing recently, because we've been getting these gap ups, right? Look at the chart really quick in TradingView. What we've been getting are these gap ups and then pullbacks. So we'll make a higher high and then a pullback. And then we'll gap up again and then a pullback. What we've been doing on the scanning portion is we've been taking this change from open and just selecting up. So what that does is if we run a 50-day high scan, what it's going to do is it's going to tell us any name that actually hit a 50-day high, and it could have closed below that 50-day high, right? But it's still going to register it as a 50-day high because it hit it intraday. There's nothing wrong with that, but given the nature of the market, we want to know what actually closed up at or near their 50-day highs. And so by going to change from open up, at the very minimum, you're only scanning through names that obviously closed green, correct? So once again, just a little caveat that we've been throwing in lately. So what we're looking for is 50-day highs, average volume over 1 million, optionable and shortable, change from open up. Very basic scanner that's going to give us some nice relative strength, potentially some nice breakouts. And what we do within TTI, we're not going to do right now, is if we know what part of the market we actually want to go look at, we'll go find it, right? If we know we want energy, we'll go to energy. And if we know we want oil and gas exploration, look at that. What did we just talk about? OXY. We have a trigger at 70. We're going to probably try to buy it on Monday if it pops back down. We just found OXY alone. And there's other areas. Let's say you want a drilling name, right? There's nothing there right now for 50-day highs that changed from up. Oil and gas. How about integrated? Let's use this. Let's use this as an example because I actually already charted this. This is a Norwegian company. It's an oil and gas integrated related name. This has hit 50-day highs. It closed up. It has an options chain and average volume over 1 million. So let's go. Is there a setup here? Within TTI, we love buying horizontal level breakouts and retests. That's kind of like our bread and butter. And if we look really quick at this setup, you can see there's a very obvious horizontal level. As a matter of fact, I'm going to zoom out here so you can get a general idea of where the stock is in terms of its historic price. Let's go out to the week so you can see we were up near all-time highs, right? So obviously back the run-up in the 2000s, if you were alive, you know, that's crazy to think about. If you were alive, you know what the GFC was. If some of you old heads were trading, you definitely know what the GFC was. You know what the run-up looked like in oil and energy back then. We are up at those levels right now, right? So XLE in general is up near all-time highs. We have a bunch of names within XLE up at all-time highs. Here we are, EQNR, which is a Norwegian integrated oil company, up near all-time highs. That's good. We like that within TTI. We like when the market likes something. We zoom out more on a shorter term scale than the weekly. We can see we are definitely up in an area that we don't have to worry about any overhead resistance. The only overhead resistance we have to worry about is going back this year, right? So we have a horizontal level at around 38.50 that we've tested 3 different times, right? One time, failed to break it. Oscillation down. Second time, failed to break it. Oscillation down. Third time, here we are testing it again. Generally speaking, the more times a level is tested, the weaker it becomes. Every time buyers come up here and try to press through, sellers come in and try to break it down. There's only going to be so many sellers at the same area. That's it. That's how this shit works. The more times this level gets tested, the weaker it inherently becomes. Eventually, it will break to the upside. We're trying to essentially buy this as it does break 38.5. So RSI is something that we utilize within TTI. We love when the RSI is above 50. We use RSI a little bit differently. Most people buy it or use it as an overbought and oversold indicator. We use it as a sentiment indicator. Above 50 to us means people love this stock. People love this stock. They don't care what the fucking price is. They want to buy the stock. I can prove it to you. EQNR oscillated right here. Actually, I don't know if this is going to stick. TradingView has been weird. But we've been above the 50 RSI, right? Going back to December. I told you guys we went long energy in the end of December. It oscillated above the 50 until April-ish. And if you look at it, most people that use the RSI, they're looking to sell the 70 and buy the 30. Sell the 70 and buy the 30. Buy the oversold, sell the overbought, over and over and over. We don't do that. We say, shit, if this is above 50, it means people like this stock. And look what happened within EQNR. As this was oscillating between 50 and 100, because this is a bounded oscillator, this thing ripped for 47%. If you were a normal, quote unquote, normal trader using RSI the way that it's normally taught, you'd have had zero opportunity to ever buy this stock again. So let's say you loved this stock for whatever reason, and you're waiting for the 30 RSI, it never came. For us, we look at this as one part of our process and we go, well, if it's above the 50, people love this. We want to be buying and not selling. Conversely, just for the sake of telling you, we only short when something is below the 50, when it's oscillating between the 50 and zero, realistically, right? Since a bounded oscillator, 0 is the lowest, 100 is the highest. So this passes that, right? This is above the 50. We came down and oscillated and bounced at the 50. We like this a lot, actually, because as we started to create a lower low, or not a lower low, but a pullback off of this horizontal level, we bounced off of the 50. And so we're looking at this as, hey, right here is telling us that buyers want this stock regardless of what the price is. They're not waiting for it to dip back down to this 30 area. They want this stock. And we're pressing into an overhead resistance area at 38.5. We like this a lot. So what we're trying to do, we know that we want some exposure into energy. This is hitting 50-day highs, right? This is giving us an area that we can utilize as a risk on, risk off level at 38.5. The RSI is above the 50. We know we have a relatively high probability chance that this thing is going to break out. And because energy right now is being rewarded, people that are buying energy related stocks are being rewarded. We saw it with the US sector and US industry strength. We feel like this is going to be a high probability trade to the upside. All right, so off of the 38.5 breakout, we were actually thinking of potentially buying it on Friday. One guy did. What we would like to see here is a solid break above 38.5 on high RVOL. So as you can see right here in the upper right-hand corner, relative volume. What that is doing is it's telling you, listen, is it above or below average volume? We like above average volume breakouts because, and I'm not going to spend too much time on this, but above average volume breakouts over horizontal levels has a 57% chance of a pullback in towards that level. What do? We find these areas through scanning. Where are we breaking out? Where are we about to break out? And then we set a trap. We go, listen, if 57% of the time, and that's academically proven, right? 57% of the time, horizontal levels, that's very key, by the way, not all breakouts. It has to be a horizontal level. That's how the test was set up. A horizontal level breakout on high volume, which is more than one RVOL, which is why we have this indicator right here, has a 57% chance of a pullback in towards the level that it broke out. So what do? We identify the breakout spot. This thing will break out, right? That's what we want on high volume. This thing will pop up maybe here. And then what's going to happen over the next day or two? It's going to pull back to here. And what are we going to do? We're going to buy this. We're going to buy the pullback for a few reasons. One, we're going to buy because if we buy this pullback right here, it's going to be cheaper. If you're an options trader, you know what it's like to buy calls a day or two after a rip. They're going to be juiced. That premium is going to be expensive. You're going to be buying 50, 75, 100% more than what you could have 2 or 3 days prior. And that matters, by the way, a lot. What happens when you buy calls on a pullback day? Those things are discounted 50%. All of the guys that bought the original breakout are now down. And what are you doing? You're buying their misery. Some of these guys are going, fuck, I'm down. I don't care. I don't care if this bounces or not. I'm down 50%. I don't want this anymore. And what are you saying? I know this thing's going to pull back statistically. I'm going to buy your bags. Your misery is now my potential treasure because what do we see? Statistically speaking, it pulls back into this horizontal level and the strong breakout continues. This is called our BRB setup. The other area that this matters, go ahead and delete some of these brush strokes so you can see it. The other area that this matters is that if you do, let's say this thing breaks out and then pulls back and you do buy that breakout spot. Let's say the breakout doesn't sustain itself, which happens all the time, by the way. It's failed breakouts, right? What can you do? You literally, your stop is the next day out. If it does not bounce, you are out. Your risk is incredibly limited. Incredibly. One day. Think about all the guys that bought here. Think about all the guys that bought here. You're buying here on a pullback, right? So you're already at a discount. This guy bought it up here at plus 75% of what this guy did. This guy bought it at plus 50% what this guy did. You're buying misery. You're getting a 50% discount. And on top of that, you are getting a next day stop out. You're losing fucking nothing compared to this guy. This guy's down 75%. Maybe he's thinking, fuck it, I'm going to let it run to expiration because there's just nothing left. Maybe he's freaking out. He can't wait to hit close as soon as the market opens. And if you do gap down or whatever, you look like you're going to close below where you eventually bought it, you just close at a minor loss. And that's the best part. You paid less to get it, and your stop is going to be less than everybody else's. This has, it's the highest performing setup that we have over the last 2 years because the risk to reward is so heavily skewed in our favor. And so this is how we attack these charts. We come up with a trading plan based off of sector and industry, sometimes factor analysis. We find the stuff through scanning. We set up our charts, horizontal levels, and then we but we plan our setups, right? One thing I forgot to mention really quick, fibs are an important part of our system, but levels should always be the first thing that you do, right? So support and resistance are the building blocks of pretty much any technical analysis system. Fibs are just a great way for us to be able to find price targets, mathematically speaking, based off risk to reward. And so in this case, if we have a horizontal level at 38.5, we can throw a fib on here and get a general idea of, all right, if our stop is potentially somewhere near 37, we know that we are risking about a 3-to-1 by targeting that 43, right? So you can actually prove it to you. It's going to be about a 3-to-1 almost every single time. In this case, it's a 3-to-1. There you go. So 43.10, we'll say 43-ish is what we're targeting. This 36.94, we'll say 37. It's about a 3-to-1. So for every $1 you're risking, you're looking to gain $3. And this is the minimum what we do for TTI. The fucking minimum you enter a trade is going to be a 3-to-1. It allows you to lose more often than win, which a lot of people need, right? So over the course of 50 trades, you might lose, 28 of them and actually only win 22 of them. And you're going to be profitable if you're only targeting 3-to-1 or better, right? Because your winning percentage, I think, is like 30% or something like that. So, and you're going to be winning something like 42%. So you are a profitable trader. So we set things up to allow you to lose and still make money over time, given a large trading sample. So 3-to-1 is the minimum. We usually, our sweet spot, at least for me, is 4-to-1. It doesn't always work out that way, which is why I like 4-to-1s. We ran a small account challenge, and we were successful in growing a $200 account to $2,000 with no lottos. Took 71 trades, and my winning profitability was 48%. So I actually lost more than I won, but my risk to reward, I targeted 3-to-1 minimum, but my sweet spot was 4-to-1. It ended up being 2.26. So I was targeting 3-to-1 and 4-to-1, but because the market does what it wants to do sometimes you get sloppy, sometimes you hit a bad beat, shit happens in the market. By setting myself up for success at the beginning by targeting 3-to-1 or 4-to-1, it allowed me a cushion to lose and kind of fuck up a little bit. And I ended up with a 2.26 to 1 R to R. And obviously the account went from $200 to $2,100 and something dollars. So it was a successful small account challenge. It was not easy. 71 trades. That 2.26 R to R was the reason why it was successful. And it all comes down to trying to find higher risk to reward trades. And this is a great way to find it. I just showed you exactly how we do it, right? So EQNR is something that we are actively looking at on, we're going to look at this during our Sunday night strategy session more in depth tomorrow. We're going to pull up the options chain, find where we want to get long. Like I said, one guy's already long this name off Friday. So we'll see what he's doing. But that was a complete step-by-step through how we analyze the market, how we find the trades, and then how we set the trade ideas up. And on Monday, if this thing does break out, we will take this trade as a group. So it's cool. We can all manage it together. If anybody has any questions, obviously they ask the group and we bounce ideas off each other. It's a very valuable part of our community. So let me go ahead and check questions really quick. I don't think we're going to have any, but the last thing I guess I'm going to go over is we're going to go through a few trade reviews. I told you guys we were going to go through a change of direction trade, and we're going to go through one of those BRB trades that we're currently in, right? So we have this First Solar name. So if you're on Twitter, Stockbees and Kulamagi, they coined this term EP, episodal pivot. I love it. Those guys, Stockbee is an incredible trader, incredible educator, but we have our own spin on this EP play, and we called it a COD, change of direction. And something that we focus on is we don't try to catch these moves prior. So if you look at First Solar here, this horizontal level-ish, Sure, somebody might have bought the breakout. Maybe they bought it prior to earnings, whatever. Congratulations. We don't do that. We're not trying to gamble. I don't care. I call earnings burnings for a reason. I was just telling Sal that yesterday. Burnings for a reason. Most people just like to gamble on earnings, and it's just, I'm not, if I want to gamble, I'm going to Vegas for free drinks and good looking girls. I don't have to do it from my bed with a Robinhood account. So I want a reason to be going long, right? First Solar broke above its horizontal resistance line at 76 off good ER plus Biden administration news. And that's what matters in a COD. The first step to a COD is you have to have a positive catalyst. I don't care if it's earnings. I don't care if it's the Biden administration. I don't care if fucking aliens are attacking us. I don't care. There has to be a positive catalyst that completely changes the way the market looks at the stock. As you can see, First Solar, by the way, is a TAN-related name. And something I want to point out, TAN has been in a primary downtrend since Q1 of 2021. It's not the worst performing, right? We looked at that at the on the U.S. industry portion of Koifin, but it's not going anywhere. It's going down and to the right, and we don't like buying things going down and to the right. Tell me why First Solar has not done that over the same time frame. We have gone just to the right. Not saying this is a good buy, but there is a difference between TAN's chart and First Solar. And just for extra credit, look at this. TAN against First Solar. What are we looking at? A ratio chart. I'm not going to go into depth with this. If you're a TTI trader watching this, you know this stuff like the back of your hand. If you're not, what we're looking for is relative strength. And if you're charting TAN against First Solar, down and to the right means First Solar is showing more relative strength than the solar industry itself. We can also do it the other way. And if it's going up and to the right, it means First Solar is showing more relative strength than TAN, right? And that's what we want. We want to see First Solar out competing the solar industry, right? Because I told you guys, we want to be buying the strongest stuff inside the strongest sectors, inside the strongest industries, right? So First Solar is going to the right. TAN's going to down and right. And so we're sitting here and we're going, okay, well, first off, there's some relative strength of First Solar. For whatever reason, the market didn't sell this off like it sold everything else off within the same industry. That matters to us. I don't really necessarily give a shit why, but we have to take note of that, right? So that's first things first. That's what we noticed. Second, earnings came out and we gapped up huge. Congratulations. This is a change. Where on this chart do we see anything like this? We don't, right? Positive earnings with the Biden administration news coming out. The market absolutely gapped this thing up 15%. Where on this chart have we seen something like that? We haven't. So there's a difference in mentality. We call it change of direction, change of sentiment, whatever you want to call it. We noticed that. Okay, so what do? We don't buy this. We don't buy the gap up. We don't buy the second day gap up. We just sit there and we fucking wait. And this is where our style differs slightly from an EP. We wait for a horizontal channel to form because we love horizontal level breakouts. It gives us a very clear area to risk on and risk off. What do I mean by that? I go, okay, if this thing forms a horizontal channel, I know that if we break above 102-ish, if we break out and then fall back down below, this was a failed breakout and I'm just going to get out. That's what I mean by risk on, risk off. Excuse me. A risk on, risk off. We need to know where we are wrong. And so by giving us a horizontal level to risk on by going long, we know that if this pulls back, right? If this pulls back, if it breaks out here and then comes back, we know we're wrong, right? We're not trying to guess what First Solar is going to be a year from now. We're trying to ride what we're seeing right now. And if the trade idea is a breakout here into this and it doesn't manifest itself, you're wrong, get out. Okay? So that's what I mean by risk on, risk off. And obviously to the downside, if we're shorting, it's the same idea. If we short and it pops back up, we get out. Let's get rid of those brush strokes. COD. We look for a horizontal range to form, and it did. Now, this is where some of the guys in TTI differ, and I encourage it. I love the fact that our community takes our system and makes it their own. And I think the first guy, shout out to Dustin, I know you're going to watch this later. He was the first guy to get into First Solar, and he actually bought on this pullback, which I'm not going to lie to you. I didn't at all. I was waiting for a breakout above this 102 area. And he goes, yo, guys, I bought this pullback because I'm drawing a level here. Why not? If we're looking for a horizontal consolidation area, I'm buying on the red day. The contracts are going to be cheaper. Well, duh, that makes total sense to me. But he was the only guy with balls big enough to actually go and execute it. So congratulations, Dustin. I think you're the number one guy in the group in terms of profitability on this trade. He bought the pullback. And then after he went out and told everybody, people started going, well, shit, I want it too. So we actually have a couple traders that are listening right now that bought around the same time as Dustin. I don't think they got the same fill on the chart here at least. And they went and they bought First Solar as well. And what do we expect in a COD? We expect a consolidation as people look to take profits, right? If you know anything about a Wyckoff market model, it oscillates like this, right? You have a period of a markup, distribution where people take profit, a mark down, back into an accumulation. So this is the uptrend, horizontal, minor downtrend, horizontal, a larger uptrend, horizontal. That's why markets go like this, right? It's called the Wyckoff market model. And what we're assuming is going to happen is off of the uptrend, we get the distribution where people take profits right here. Everyone that bought this, everyone that bought this, they're starting to take profits here. It's starting to, the uptrend is slowing down, and they're going to take profits. But what we notice, let me get rid of these brush strokes, is that support is holding. I don't care who it is. I don't care if it's an institution. I don't care if it's your grandmother's plumber that has a shit ton of money, because plumbers make a lot of money nowadays. I don't care who's propping the bid up. I don't care. But what I do care is I notice it. For whatever reason, the market is not allowing First Solar to break below 95.5, overhead resistance at 102. We would expect this to continue the trend to the upside, and it did. Now we're running into potential all-time highs, which we actually hit, I believe, or we were like a few pennies away. And some of the guys in the group took profits on the way up. Some of the guys in the group took profits on this day in particular. And I know a decent amount of guys are still holding some contracts that are free at this point. That's the best part. You are up at a level testing all-time highs, and they are free. These contracts are up 300, 200, 300, 400%, depending on which who the trader was within the group, because people bought at different times and different contracts. This was a winning trade for everybody across the board that got in. And the guys that got in early enough, like Dustin here, they're in a free trade. So they can actually allow this thing. Plenty of room, by the way. We buy at least 45 days. That's the minimum we'll buy out, but generally we buy like 60 and potentially out to 90. These guys have either September or October expirations, if I'm not mistaken. They have so much time. We're consolidating below an all-time high. These things are up multiple hundreds of percent. They're already free. Why not let these things have the opportunity to prove us right into an all-time high? So this is the COD trade, right? We identify a positive catalyst. We patiently wait for a horizontal level, and then we buy the breakout, or if you're Dustin with balls of steel, you buy the pullback into the support area. That's it. This is how you make hundreds of percent on a COD options play. Okay, so the next one I'm going to go over really quick is our ON. This is the BRB setup that we actually went through for EQ and R here. I was talking to you guys about how we're going to play this. Like, this is how we're going to play this on Monday. We're going to go through this tomorrow during our strategy session. We're going to set up the contracts. We're going to set up the expirations and what we expect out of this. We're expecting a breakout with a pullback. We want to buy the pullback, and we expect another move to the upside. What did ON do? So I posted a video on YouTube, I don't know, a few sessions ago, probably a week ago actually at this point. ON was the #1 semiconductor name we wanted to be looking at buying for plenty of reasons. I'm not going to go through them right now. You can go back and watch the video. I put a bunch of content out on it. But, you know, in layman's terms, it was the strongest looking stock other than Enphase, which had already broken out into all-time highs. So if you look at Enphase, this is a COD as well. Ian, one of the TTI traders, traded Enphase as an open range breakout and actually held through a majority of this portion. It was a fantastic trade. I think he was the only one in TTI to actually trade Enphase, but it was a profitable trade. Excuse me. But we're not looking to buy Enphase up here, right? We're looking to buy Enphase on a continued push above 304. So what are we doing with ON? Well, we said shit. ON looks just like Enphase. We don't want to be buying shit like AMD. This sucks. We don't want to be buying shit like Nvidia. Look at this crap. This stuff's going like this. This stuff's going like this. Look at TSM. This stuff's going like this. Why would you want to buy that? Look at this. This is going this way. That's relative strength. You look at ON versus SMH. SMH is your semiconductor industry. Well, I don't know. This looks like relative strength on a ratio chart, right? If ON is going up against semiconductors. You know that if semiconductors are starting to get industry inflows, if you know XLK is starting to get sector inflows, you want to be buying the strongest stock within that area. ON fits that bill. And it just so happens we have a horizontal level setting up. So what did we do? We said we're buying this pullback on the breakout. What did we get? ON broke out on August 12th. We did not buy. Congratulations. We did not buy. Look at this. ON breakout. What is volume telling us right there? Is it above that funny orange line? That's above average volume breakout, above 1 RVol. Is RSI above the 50? Absolutely. So what do? Like a fucking cobra, we sit there and we wait. And we wait for a pullback into this horizontal level. We draw a box because we understand in TTI that we are swing traders, and a resistance and a support level is a zone of price, not a specific price point. That is a difference in scalping and day trading and swing trading. Scalping and day trading, you are tighter on those stops or on the supports and resistances because you're dealing with pennies differences. We're not as swing traders. So it's a zone that we're looking at. In this case, it's a zone that constitutes about 2.7%. We said if ON pulls back in towards this zone, we want to be buying. Once again, why is it beneficial to be buying on this day? Multiple reasons. Cheaper contracts. Imagine buying here. Imagine buying after ripping 5 days straight or whatever this is, and you're buying contracts on this breakout. You're going to be paying 100+% on your premium. What happens if you wait 2 days for a potential pullback? By the way, which might not happen. I just want to point that out. There are plenty of times where we wait for pullbacks that don't happen. But statistically speaking, 50%, 57% of the time they do. That is enough to build an edge around. Okay, that's important. Trading is not just buying a fucking Ferrari and running a paid group and selling signals. Like actually knowing how to do this through stats matters. If you actually want to do this, understand how markets function and look at the numbers behind it. 57% chance of a pullback. We waited for the pull in towards a horizontal level. We get cheaper contracts. And if we don't bounce here, we're cutting right here. This guy buying here, his stop is below the support level, right? That's how trading works. You buy the breakout, place your stop below the support level. Well, depending on how balanced of a trader he is, this broke below his support level. Did he sell? He probably did. There's probably a large number of traders that bought this initial breakout that sold on this wick. We don't do that in TTI. We try to time all of our stuff towards the end of day because we don't want to get involved in intraday volatility. We know that the market will fuck people intraday, and because we're swing traders, we want to take advantage of overnight moves, not necessarily intraday moves. So we do not sell on stuff like this. We try to wait for end of day. It doesn't always work in our favor, but more often than not, it does. So yeah, there are definitely people that bought this breakout. They got stopped out on this wick, unfortunately. And what did we do? We bought it. Seriously, we buy this shit. If it doesn't break, or it doesn't bounce rather, the BRB, breakout, retest, bounce. If it doesn't bounce, we're out the next day for a minor loss. In this case, ON did break out. And what did we see? We saw off of the low, which I'm going to be honest with you, I'm cherry picking a little bit here, but I'm super proud of these guys because these contracts are up over 100%. Off of the low, it bounced 12.58%. If you were to time this perfectly, which I don't think anybody in TTI did, but just for hypotheticals, this is up 12.58% into an all-time high the very next day. Matter of fact, on Thursday's session, this was up 7.26, and at the peak there, it was up over 10%. So yeah, they bought the dip in a stock flashing all-time highs, right? This is an all-time high. There's your risk on level in an area of the market within SMH that is showing relative strength, and ON was one of the names within SMH that is showing the greatest. Like I said, we could have bought AMD. What the fuck is this? What is this? We don't want to be buying stuff going down and to the right. We looked at NVIDIA. There's other names. TSM, right? Trying to think of like names off the top of my head. I can't think of stuff. I know Wolf had a CO. This is a COD. Look at this. We haven't set this up, but I know Wolf is one of those names because we were talking about, we have a guy in our group named Kevin. Shout out, Kevin. This is a name that just reported some outstanding ER as well. So there's a COD. You see the big gap up. Does this thing eventually consolidate? Can we buy this 112.50-ish area breakout? Maybe. Have to verify that on the options chain. But for a majority of these semiconductor names, they're looking like the semiconductor space, which is down and to the right. If you can find something going like this or like this, buy these. Do not buy this, right? Don't do it. Even if it turns into a profitable trade, there are better trades out there. Buy the stuff that is going up and to the right over time. Okay, so I just went through BRB. I went through a COD. I'm not going to go through the big blue sky setup just because there's not a whole lot in the market right now, and I think we're already pressing into 1 hour. I'm going to, let's see here, answer some of the questions, and then we're going to call it a day because it's Saturday. And I'm in Brazil. And just so everyone's aware, this is the coldest day of the year in Brazil. It was 45 degrees this morning, and these fuckers are like talking about how they were going to like freeze to death. But the houses that are built down here are like ice boxes because in the summertime it's like 110 degrees. And so it's legitimately 45 degrees in this house right now, and it's pretty miserable. So I'm going to go outside where it's 60 and be warmer somehow outside than inside. Answer some of these questions. I'm going to hop off. I appreciate you guys showing up. I'm going to start with YouTube, and then I'll go to Discord. Let's see. When do you add a play instead of just take profit? What gives you the confidence to stay in or add? You just answered. Shout out. I appreciate you for asking a question. When you add a play instead of just taking profit, what gives you that confidence to stay in or add? I'm trying to think of a specific example that I can give you. Hanno or Dustin. I'm not sure if you guys have access to your microphones right now. They're in Discord for anybody watching this. Want to piggyback off this with me? What gives you the confidence to... Hanno's been actually doing this for the last like 2 months. Hanno's a newer member. I think he's on his coming up on his 3rd month in TTI. If you guys have access to your microphones, Hanno, for example, what gives you the confidence to want to add in on a play as opposed to just taking profits? If you can't answer that, I'll do it. But I'm going to use you as an example anyway.
Hey, Hammy. Usually, for me, if we have relative strength in that sector and we're coming back to a retest on a specific horizontal level, and we see that bounce on that horizontal level, gives me a lot of confidence to add in. In fact, I think one of the biggest add-ins successes that we had together was Datadog last year. Came back intraday on a horizontal level after the breakout, and I think we added in and then it just shot up. So that was a good example of that.
Another example that I can think of right off the top of my head for me and you specifically, because I think CVX was probably our biggest trade this year, money wise, not percentage wise and money wise. I made more money in CVX than any other ticker. We continually added in on CVX, didn't we? Every time we were about to, we get up towards 20 days to expiration or something, we'd find a level that we could risk on again, and we'd just roll our contracts out for another 1 to 2 months and just continue the ride up. And I actually remember right when the news broke that Russia was invading Ukraine or whatever, I think it was like 2 days prior, we had just bought the pullback. And then we had, I'm looking at the chart right now, we had this monstrous run of like a 25% move into all-time highs in CVX, and our contracts were up like 2,000%. And it was just because we were buying in on pullbacks and strong uptrends, right? But you're right. We use horizontal levels.
Yeah.
I mean, that's the basis of everything that we do.
And you have to see the relative strength in that sector too. If the sector is going down and it's not showing relative strength, I'm not going to buy into a pullback. I'll be selling off my position.
And the reason why you're not willing to buy pullbacks in sectors that are in downtrends is because maybe one company might specifically be doing something great, but eventually companies will succumb to the sector outflows, right? We also saw that with Apple. For anybody watching this later, we had been watching Apple software names in general. Tech were getting slaughtered Q1, Q2. Apple was not. And people were buying Apple incessantly in March. And then all of a sudden we saw at the end of March through the beginning of June, Apple sold off 27%-ish, 30%. And we have this saying in TTI, it's not a TTI saying, but we say it all the time, that the generals get shot last, right? And that means specifically that the best performing stocks might hold up the longest because they're the best, but they are not immune to larger sector or index movement. And so if we know, hey, tech is selling off, sure, Apple might look better, but in the end, Apple is eventually going to sell off as well. And in this case, it was because there was a rotation out of growth in general, right? So thanks for that, Dustin. Hanno says, I completely agree with Dustin. I think the only time I didn't play like that was after AMD earnings. The earnings were good. The government was supporting semiconductors, and he felt pretty confident off that. Yeah, so it makes sense. Everything that we do is based off of horizontal levels. And in Hanno's case, he played AMD 3 different positions, and all 3 of them ended up being profitable. I think the last position he just closed was this breakdown off of this symmetrical triangle. He sold this for an 8% profit, if I'm not mistaken, but the other 2 were up multiple hundreds of percent. So all 3 trades green. Didn't miss a beat. And shout out to Hanno, by the way. Like I said, our system is not particularly easy. There's a lot of moving parts, as you can see. But as a 19-year-old college student, he is absolutely outperforming everybody's expectations, and he was able to ride AMD through 3 different contracts on this push-up. So I appreciate you throwing that out there, Hanno, and also good job. Off of, let's see. Let me read what's up, Adam Havoc. Do you set your stops when you place your order? Anybody want to answer that really quick? Dustin, do you set your stops, or how do you run your stops?
Don't really set stops. We just I just take a look and seeing if we break below where the play is then made invalid. So, let's say I'm playing a horizontal resistance, I'm playing a BRB, and it breaks above, comes back and retests it. But let's just say it doesn't retest. Let's just say it keeps going down past that spot, that horizontal level I picked. Then now I know the play is invalid. It's not going to retest that spot. So then I'll stop out. I'll manually do that. I do not set up automatic stops on my charts or on my plays.
And I don't think anybody in our group does, but I'm glad that you said that, because I wanted to hear your answer, because I actually don't think I've ever asked you, but that's kind of like implied within our group, right? We don't set stops in our group. We use chart-based stops, and a majority of guys are options traders. So it doesn't make sense because, for example, if you're a theta guy, right? You're a theta gang guy, and you're just essentially trading the probabilities of plays specifically on the options chain. You don't necessarily give a shit about what a chart looks like. If you're playing a trade that has a 95% chance that it's going to win, your reward is going to be very low. But you could play that out a million times, and hopefully you don't hit that 5% loser and wipe out everything. But the reason why I say that is because if you're trading based off of a chart, your trades should be based off of the chart. Your trading vehicle should not matter. If you're trading equities, your stop should be the exact same place as your options. And that's a hard thing to do, because obviously if something pulls back 5% in the equities world, you're down 5%. Something pulls back 5% in the options world, you could be down 100% depending on what the IV is. So we do things that mitigate that. For example, anything above 50 IV, we always go into call or put debit spreads. We always spread it. That helps us alleviate a lot of the IV crush. We don't buy things with less than 20 days till expiration, but that's like we close at 20 days of expiration. If it's sub 20, we know that theta starts kicking our ass. We always buy at least 45 days till expiration, but potentially 60 to 90. And we play chart-based stops, and we do it manually. So as a group, we'll set a trade idea, and we'll go, listen, if we're playing a breakout above 100 and the breakout is invalidated at 97, close your positions at end of day if we're closing below 97. And that's it. And we all do that. And it's worked better, because what we've noticed is, specifically in this bear market, is we'll see a lot of intraday volatility where we'll get wicked out if we had stops on the books, and then at the end of the day, the market will slightly recover. We'll close above our risk on level, and then 3 days later, we'll be hitting higher highs again. And so those manual stops have allowed us to be fluid, and because we run our stops at end of day, which is important, right? I've said this like 4 times in this session. It's important to note that we do a majority of our trading either within the first 15 minutes or the last 15 minutes. First 15 minutes, we like to get in on BRBs. The last 15 minutes is when we stop out. But we do everything manually specifically because of that. So Hanno says he's talking about volatility-based stops. So Mike and I used to trade volatility-based stops based off of ATR ranges. And Mike, when he joined our group 2 years ago, was interested in that. And so Mike ran something called a chandelier exit system based off of ATRs. And at that point, I had already stopped. I realized, at least in my trading style, that chart-based stops based off of level breaks was more profitable for me. Mike ran ATR-based stops for about 3 months, and then he realized his losses were huge because in a highly volatile market, your average trading range is going to be huge. And if you're running like a 2x or a 3x ATR, you're going to be risking double-digit equity moves and stops where the stock itself might move $2 or $3 a day. So at that point, your option is expired, even like worthless, even before the stop gets hit. So it just didn't make sense to run volatility-based stops. And so he stopped doing it and immediately saw a more profitable system. So as a matter of fact, if you're interested in that, I highly suggest you reach out to Mike and just ask him what his feelings are, because it makes sense on paper, but it just did not translate over to the market. For whatever reason, the volatility-based stops, I think it's because the market is incredibly volatile right now, so it's just the losses are going to be bigger, and that's it. For an options trader, those huge steep losses are going to essentially kick you out with 0% every single time. Okay, how long has this been on? An hour and 16 minutes. That was good. Cool. I appreciate you guys showing up. Landon's here at the end, as always. He must have just woke up. Okay. Adam, I appreciate you. Thanks for asking the questions and stuff. For the guys in here, thank you for showing up. Thanks for helping me out, Dustin and Hanno. Sal, thanks for listening to me jab while you're working, and everybody else that tuned in. This is the highest viewed live stream I've ever had, so that's kind of fun. This is recorded. You can go back. You can listen to it. It'll be on my YouTube, so it's yours. And yeah, I appreciate you guys. Thank you so much, and I'll catch you later. Enjoy your Sunday. Enjoy your Saturday.